Okay, so we have three types of stock transport orders, either without delivery or with delivery, and with delivery and billing. And let's look at each one separately. So when we have it without delivery, now we're talking about a plant that is the receiving plant, and the other is the sending plant. So the receiving plan starts, it could be they start with a purchase requisition, a request of transferring goods from one plant to the other. And they also create the stock transport order. So once the requisition is approved, that gets translated or copied into a stock transport order. Remember, in purchasing, we had the purchase requisition copied into a purchase order. In this case, we have a purchase requisition or a requisition copied into a stock transport order. So the receiving plant creates the STO. Now, the supplying plant, once they are ready to send the material, they will issue a goods issue, saying that the goods are about to move or move to the transit area to be sent to the other plant. In that case, when we have that stock transport order, you can only do the two-step procedure. So you send out of one plant, go into transit, and then move into the storage location of the receiving plant. Now, so two-step procedure. Remember, anytime we're moving from one plant to the other, it's always unrestricted use. It cannot be blocked, cannot be in inspection. So the sending plant would create a goods issue, and the receiving plant first starts with the stock transport order and then creates a goods receipt, and they have to match the goods receipt with the stock transport order. Now, of course, now I have to reflect on the FI documents. So I have to show a financial document that will show a decrease in the inventory of plant A and an increase in the inventory of plant B. And so the material accounts will have to be adjusted. And then because I have to go through transit, I have also the clearing accounts. So you can see right here, you have the supplying plant, that's the seller. You have the receiving plant, that's the buyer. It starts with the receiving plant either creating, as we said, a requisition and then copying it into a stock transport order that gets sent to the supplying plant. When the supplying plant is ready to send the material, they issue a goods issue. Material gets sent into transit and then moves to unrestricted use in the second plant. Now, the second plant, once material moves from transit, they issue a goods receipt because they are receiving it and storing it into their storage location. There has to be financial documents created, either one, because the two plants are under the same company code, or it might be two financial documents if you want like to create cost accounting at the plant level. How about now stock transport orders with delivery? So, or what's the difference between without delivery and with delivery? Now, without delivery, you don't assume that there is picking and packing. So you don't create any delivery note document in order to pick the material from storage in plant A and send it to storage in plant B. No picking or packing is involved. That's in without delivery. But sometimes you need, like, you have to treat the receiving plant as a customer. So you have to, you do the exact same steps like you would do with fulfillment, which means as soon as you receive the stock transport order, you will create a delivery note. Remember, we did an outbound delivery. You will create a delivery note in order to allow picking up of the quantity from storage into the packaging area where they get packed, and once they are on the shipping dock, then you issue a goods issue. So in that case, the stock transport order, in the case of with delivery, is treated exactly like a sales order. You would do exactly the same like you would do with the sales order, which is create a delivery note, allow like to move material out of the storage location to the staging area where they get packaged, and then move them to shipping and issue the goods issue. So you can see right here, I create the stock transport order. As soon as the seller or the supplying plant received this, they create a delivery note, allow material to move out of storage location to packaging area, and at that point, after they are packaged, you issue the goods issue, sends the material to transit on the receiving plant side. Once it moves out of transit and into the storage location, you create the goods receipt. In the two scenarios that we just covered, with delivery and without delivery, there was no billing involved. So you didn't see any invoice being created. But again, now the third scenario, you would create the delivery note, but you also have an invoice being sent to the receiving plant. The receiving plant acts exactly like a customer. So like any purchasing organization, they will have to verify the invoice against the stock transport order. They have to go back to the stock transport order and verify that the price on the stock transport order is the same as on the invoice, that the material sent from from plant A to plant B is the same material that is specified on the stock transport order. So my goods receipt must match with the stock transport order. My invoice must match with the stock transport order. Now, the purchase price is something that is offered or is provided by the supplying plant. So the supplying plant, because they are the sellers, they are the ones to provide the purchase price. It cannot be that the receiving plant will suggest or determine the purchase price. So they of course use some kind of an algorithm in order to determine the internal pricing of the good. So you are internally transferring material from one plant to the other with delivery, because it involves like the delivery note, the packaging, and with billing, and that would involve the invoice. Once it is received, then my goods receipt, the verification occurs, and that is verifying that the whatever is on the goods receipt is the same as the stock transport order, and what the price on the invoice is the same as the price on the STO. Now, what effect will that have financially? I know, of course, it will have to reflect on inventory. I have to credit inventory. I have to credit the material. And remember, when it is an asset and we say credit the material, we're saying decrease the amount. So crediting material means decreasing the amount of a material in the supplying plant, and debiting the material again on the receiving side. The cost of goods sold, of course, is also affected, so you have to debit the cost of goods sold. So again, as soon as I get the goods issue, then I have the goods issue at the supplying plant, then I need to credit material, I need to debit cost of goods sold. On the receiving side, as we said, we need to reflect on inventory, so I have to debit inventory, I have to credit goods receipt, invoice receipt. Now, the price of the good at the sending plant may be different than the valuation price or the purchase price for the receiving plant. So it could be that plant A will need to generate profit by selling to plant B. They don't sell at cost. Of course, because every plant is responsible for generating profit and want to maximize the profit, they will sell at a profit. They will not sell at cost. So the cost of goods sold in plant A is different from the price that is paid by plant B. Of course, the difference will reflect on revenue or profit for plant A. So the price that appear on the STO is what they agreed on, what plant A and plant B agreed on. It's not the valuation of the supplying. Remember, in the previous two scenarios, the stock transport order without delivery and the stock transport order with delivery but no billing, in both scenarios I told you that the price is, or the valuation of the material is at the supplying plant. But when there is billing involved, then the price is what they agreed on. The price is like, same thing like with a customer. You don't sell to the customer at cost. You sell at a profit, and whatever you both agree on is the price. So that's exactly the same with the stock transport order with delivery. One thing that is different between stock transport order with delivery and billing and actual selling to a customer is that in that case you don't have any payment. You don't have payment being sent, but funds are transferred from one account to another, because we're talking about selling from one plant to another within the same company code, or at least within the same client. So you don't have to involve payment. We can just have transfer of funds, but still the accounts receivable on the sending side and the accounts payable on the receiving side will are updated and needs to be involved in that transaction. So when I receive the goods and I am the receiving plant, of course I have to debit my accounts receivable. Same thing when I send the material from the sending plant and I issue a goods issue, my accounts payable is updated. So here is the figure. You start again with a requisition on the receiving plant that gets copied into a stock transport order, sent to the supplying plant. They create a delivery note, and after packaging they issue a goods issue, send to the receiving plant, gets received in transit, and then moves into the storage location, and that's when you issue a goods receipt and increase reflect on your unrestricted use inventory, you have to debit inventory. Of course, you also receive an invoice. You have to so you're sending or your supplying plant will send an invoice. You need to verify the invoice against the STO, and of course after you enter the invoice it needs to reflect on accounts payable. Once the transfer of funds is done, then the accounts payable and the accounts receivable are updated. One thing I forgot to mention is that when you issue the invoice at the billing stage on the supplying plan, of course your accounts receivable are affected at that point.